This topic's under legal, business, and ethics and law, even though it's insurance, because you do need insurance, and a lot of it's because of legal requirements. Legal requirements required by the law, also requirements the good business practice to have the insurance, because quite honestly, there's a tendency for people to get sued in this country. And again, it's not uncommon for a financial planner to be notified that they're going to be involved in a suit for some reason. The only instance I ever got involved was I was in an office building, and one of my clients was going down the stairs after leaving my office, and the stairs did not have a line marking the steps started there, and a woman tripped and went down the stairs and broke an ankle. And she sued me and the apartment, the office building owner, and the lender to the office owner, and I think she had 50 people in the lawsuit. I was only one, and of course they all had more money than I had, so I didn't even have to hire an attorney because she got what she wanted from all the other parties. But I think I've always believed very heavily that you should have an insurance if you want to keep your business from going under. So the goals of our module are discuss what cannot be insured by U.S. insurance companies, understand modern risk management theory, explain need for yearly insurance reviews, and finally to discuss why air and omission insurance is so important for financial planner practitioners. And it's probably something you know more about than I do. I don't know. But let's start with the uninsurable risk. You cannot buy insurance in this country under government, the insurance companies authorized to do business in the United States for intentional acts, for punitive damages, for regular business debts, things or individuals which you don't have an economic interest. You can't insure for more than the economic value, and you can't insure an illegal act. Now, that's a good starting point. There are alien policies that you can buy from overseas, such as Hong Kong, England, Germany, that are much broader insurance than we have in this country. The sources of them are on the internet, as well as if you talk to some of the large insurance brokers can tell you about these airlines who can cover some of the items that you cannot get covered in the United States. But I've had problems with clients who 50-year-old business person, and he wanted to insure his wife for $1 million. And I said, well, what's the wife do? Well, she's a housewife. And I said, well, she doesn't have an economic value at her age and her skill level, and the fact that she doesn't have any job to value $1 million life insurance policy. I said, if she was younger and you had children, you could come up with the value hiring someone to take care of the house, take care of the children. But since your children are all out of the house, and there's not really a large economic value involved. Well, he got kind of upset because he was determined that his wife should be insured for $1 million. And I think that's just an example of you can't insure more than the economic value. And again, intentional acts you cannot get insured in, and a lot of people want to. Overseas, actresses have been insured for their legs, and I can't remember if it was Betty Grable or one of the others. The actresses at her time period had her legs insured for $1 million. I've known baseball players got insurance that their arms wouldn't go bad, and that was obviously for pitchers. So again, those are not policies you're getting in the United States. You're buying it from overseas companies. Risk assessment is part of the business plan. The financial planner, business owner should always include risks that will be faced by the venture. And the plan should also cover if the risks are to be self-insured through capital reserves or if you're going to buy through an insurance company. Those are really your only two choices as a business person. I had one person who said, well, I've always talked my way out of my problems. Well, I'm not sure that that was a true statement, or maybe someone just trying to impress me. But I find that if we can't self-insure, then we better have insurance for it. Let's take a look at modern risk management theory as it relates to your business. I know you covered it in your insurance courses, and some of you probably use this in your business. And each item addressed as a risk in the business plan should be identified with one of the more following solutions. So you go through your business plan, and which should cover everything your business has, and look at what could be a potential risk and check off which one. First one is retain the risk by absorbing the potential damages. Second is transferring the risk so that some other entity absorbs the potential damages. Of course, that's called insurance. Show the risk so that the potential damages are split with deductibles and thresholds, which is what we call showing this risk. Reducing the risk factors so the potential risks are minimized. And finally, eliminating risk by not doing anything that would cause a risk. And we really look at everything to see which is the most practical. Again, the general rule is that if something's going to happen quite often and it's repetitive, it's not a good idea to buy insurance on, because the insurance costs are going to be astronomical. Insurance should be bought for items that are very expensive that don't occur very often. And if it's very expensive and occurs very often, that's something not to do. And my favorite example of that is if I live on a place where it floods twice a year, either through hurricanes or snow melting type situations, and I'm sure I'm going to have it every year, the flooding, maybe I ought to move. Or what a friend of mine did is moved out of the bottom floor of the house, made that empty, and added a third story, so they lived in the second and third story and let the water flow through the first story. And of course they had everything in the first floor set up for flooding by having the proper paint, etc. in there, and not keeping anything of value in place. So there's all sorts of different remedies you can do, but they're limited to these 5, and I think everything should be approached and a reason for buying it. Again, things of small value, don't buy insurance on. And ones I personally consider too small to buy insurance on is dental insurance, because my teeth are basically good. It's going to be a rare case that I'm going to spend over a couple of $100s a year for insurance. And if I need a crown or something that's only $1,000, which might occur once every 10 or 15 years, I don't really need insurance in it. Likewise for animal insurance, the probability is that you're going to be paying a lot more for the insurance than what you'll probably use if you have a healthy animal. So you feed it right, you visit the veterinarian properly, you probably shouldn't get involved with the insurance. Again, small dollar values really doesn't pay to do it. And in stores, if you have a client, for example, who has a retail store, he's going to or she's going to have theft by the employees, they're going to have theft by the clients. Again, it's not really worth getting insurance for it because of the relatively small dollar value and percentage of total. The cost of the insurance charges by insurance companies vary drastically, as do the services and timeliness. Due diligence requires the practitioner to find responsible insurers who will pay a reasonable amount in a reasonable time after an incident. And I must tell you, that is a very important. There's so much variation in when they pay and how long it takes and how much they'll pay in a situation. I would much rather spend a little bit more for insurance and get a responsiveness than having to wait. And I see that in my estate planning practice when I do life insurance policies, where there are some companies that will take 9 months or a year to pay off a life insurance policy after death, and others pay within 30 days of receipt of the death certificate, assuming everything's clean on the death certificate. So if you've got a family that's relying on life insurance, and that's usually why you're paying for it, I would certainly want the policy I paid off in 30 days rather than paying off in a year. Um, if an automobile or residence are used for business, separate coverage is required, and I think that's an area a lot of our financial planner practitioners miss. They don't get the insurance for their automobile, and yet they use it for business or for the residence, and yet they'll have an office in their house, and yet again, it's not going to be covered, and therefore you're taking a pretty big risk by not having that coverage. And to me, the insurance premiums for both the automobile and residence for use for business use are very reasonable. It's not something that I'm more shocked at the cost of basic auto insurance than anything else. But I felt reasonable for what I'm paying for the business usage. Costs continue. Major elements of insurance cost, I think you're aware of it, is premiums are based on the amount of coverage, the type of coverage, and the risk of that loss. And again, let's face it, it varies drastically by insurance company. Here in California, for example, the state insurance commissioner publishes on the internet auto insurances, medical insurances, disability insurances, and property ownership insurance companies, how many claims are valid against them, that are made against them for not performance. They cover how much business they do, and in the case I just recently saw, they give an example of auto insurance charges by company. And the state also in some cases ranks the companies as far as the quality of product. And so that's a place I look for, because I'm in California. I can get a lot of information about which insurance companies I do as part of my due diligence by using the state insurance website. And it's always up to date, and based on the experience of myself and many others, it is very accurate. So it's a good source to go with if you're in California. I suspect other states do it too, although California is usually leaders in things like this. The methods of determining premiums is the class rate, changes the same rate for everybody in a homogeneous class. Then there's a schedule system, base premium adjusted for certain current positions and negative features of what is being insured. And finally, the experience rating, when loss experience of this particular practitioner is determined premiums. And all three are used in the types of insurance you buy, depending again on the companies you deal with and the type of insurance you're buying. Insurance the practitioner uses and is aware of, that is important. Officer and director and liability insurance to cover the directors and advisory council members in suits against the company. And it's not uncommon for when you sue the company, you sue the board of directors because they're running it, and the advisors. That insurance, if you're serving on a board of directors or as advisory council, which many practitioners do, I would certainly insist they have the insurance. And if they don't have it, I'll buy it for myself, because the suit values can become very high charges. And let's face it, many times the advisors and board of director members have a lot more money than the company that's being sued, and where the money is where it's going to get this lawsuit. Commercial umbrella insurance covering additional coverage for potential liabilities of the practice. I know we all are aware of umbrella policies for individuals on their home and a car, but you can also get it for your practice. Riders on homeowner policies covering business records and home office expenditures, and I think that's definitely one you need, because it isn't covered by your regular homeowner's policy. Data breach insurance protection, another one that's becoming very popular because there is so much data breaches today. Buy-sell insurance, again, what you probably talked about with your clients, but to bring it up for you, ones that buy-sell agreement that are a commitment to buy the stock or partnership interests of a practice when one of the owners is retiring or dies. And I'll tell you, in a partnership, it's much better to have this than have your partner die and the spouse and children decide to take their place in the business because they've inherited the ownership. And I think that if I ever do a partnership again in my life, or be owning a small corporation with limited shareholders, I will definitely have this insurance, so that I don't have to worry about them buying out, because what it does is it gives the family members, the beneficiaries, the money so that I can keep the practice from them becoming part owners of it. It also protects the firm from having outsiders gain, which are the heirs we're talking about, gain ownership interest, at the same time provides guaranteed funds for the estate and liquidity for the business. So there's multiple purposes for your business. And again, this company, it could be a limited liability company, it could be an S Corp, it could even be a C Corp, as well as a partnership. It's a very useful tool to keep relatives from taking over your business, relatives of your heirs of your partners or fellow shareholders. Key person insurance, if desired, is to have children or grandchildren run the business. Key person policy on the owner can be used to loan the money to the business to the junior members, to buy out the siblings. Also could apply to an employee or friend waiting to take over the business at death. Now, one of the problems I've found personally is if you're a small company, insurance companies in the United States do not want to offer key person insurance for you. They, for some reason, have a minimum size company they'll get involved in. However, if you go outside to the alien insurance companies outside the United States, they do cover it. And I had a policy with a English company, which is a key person, and I actually was paying less than people here in the United States were paying for the same policy. And English law is as good as American law as far as I'm concerned, and the insurance policy was a company that had been around for several hundred years. So again, not a lot of risk in it. And if you get key person insurance, there are tax ramifications. And as a tax preparer, also you should also get legal advice when you get involved. In addition to your insurance agent, when you're dealing with key personnel policies that are from outside the United States, because again, those alien policies are subject to U.S. law, and certain things that your lawyer can help with that the insurance agents would not be knowledgeable about, or if they aren't, they're not telling you. And there are tax issues also, which again need tax advice on. So it's not straightforward. Types of real estate licenses and leases, failure to have the right lease agreement is a major risk for a practitioner. Because I started out in the legal field, very familiar with leases, and has been a landlord and very familiar with leases. And as a tenant, I've always read my leases very carefully, and I found there's a substantial savings by understanding the lease. Unfortunately, most financial planning practitioners do not read their lease. They make assumptions, or they listen to that salesman, and the salesman is not a fiduciary, by the way, so his job is working for the best interest of the landlord, and sometimes you get very much misled. And I'll be quite honest that one lease I was working on, as for my renting a place, and I listened to the leasing agent, and he sounded like a great lease. I looked at the lease and said, what you got here is not what you're explaining. And so we had to do a lot of compromising. So let's take a look at the type. First, the gross lease, when the leasee pays the base rent and is not obligated for any other expenses. That's the one I like to have. It's nice, clean cut. Then there's the single net lease, where a leasee agrees to pay a monthly rent as well as the property taxes. Makes it a little higher. A double net lease, where the leasee agrees to pay monthly rent as well as the property taxes and property insurance. Now we're getting even higher cost. But the only thing I like about this one is I'm controlling what the insurance is covering, so that I don't have to duplicate the insurance. Triple net lease, when the leasee pays a base rent as well as the property taxes, insurance, and maintenance. And again, there are cases where I much prefer having control of the maintenance of the building office I'm in. At the same time, I don't necessarily care for having to pay the maintenance for the parking lot, because I will have relatively few cars compared to the other tenants of the office building. And then there's the absolute triple lease, when the leasee pays a base rent and all operating expenses subject to the lease base, including the structure cost. And I note here that base rent may include a percentage of sales dollars with a flat rate for rent. And there again, that won't probably apply to a practitioner, but if your client has a retail store, they are generally going to be saying not only the flat rate, but that percentage of sales dollars. And I actually had a client who said he rented the building. He was unaware, he said, that the lease required him to pay, I think it was 4% of his sales dollars as part of his rent. And he claimed he never was told it. He said he didn't see it in the lease, but when I looked at the lease, it was very clear that that was in there. And the next thing is additional costs to obtain real estate lease. Generally, the leasee pays the brokerage commission, the lease agreement, legal fees. In some cases, the law of supply and demand results in the lessee paying bonus payments to lessor to acquire the lease. When business is down, the lessor may pay an inducement fee to potential leasee to sign the lease, and the practitioner can negotiate the gross lease. And it's not a bad idea to sign a very long-term lease period when the market is down, and that's when you sign the 10-year lease. You don't want to sign a 10 lease when the market is tight. Unfortunately, law and supply many times makes you to get the lease, sign the 10-year lease, and pay with the triple. And that's it for right now.